Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today we're discussing a significant potential shift in Canada's mortgage regulation landscape. The Office of the Superintendent of Financial Institutions, or OSFI, is considering replacing the current mortgage stress test with stricter lending rules for banks. This would mark a notable change in how mortgage risk is managed in Canada.
That's right, Steve. The idea here is to shift the responsibility from individual borrowers to the lenders themselves. Instead of focusing solely on whether borrowers can handle future interest rate hikes, the new approach would impose tighter restrictions on banks when it comes to lending to high-risk borrowers.
Exactly, Janine. Currently, the stress test requires uninsured borrowers to qualify at an interest rate of 5.25%, or their contract rate plus 2%, whichever is higher. This rule ensures that homeowners can still afford their mortgage payments even if interest rates rise. But the stress test hasn't fully stopped borrowers from taking on large debt loads.
And that's a concern, Steve. OSFI's internal analysis found that many borrowers are still securing mortgages that exceed 450% of their household income. It seems the stress test hasn't been as effective as hoped in preventing these high loan-to-income ratios.
To address this, OSFI introduced a loan-to-income cap earlier this year, limiting federally regulated lenders from issuing more than 15% of their quarterly mortgage originations to borrowers whose mortgage debt exceeds 450% of their annual income. This is a more portfolio-level approach, focusing on the lender's practices rather than just the borrower's qualifications.
It's an interesting shift in strategy, Steve. The regulator is now assessing whether this new approach could fully replace the mortgage stress test. While some borrowers have criticized the stress test for limiting affordability, OSFI warns that removing it without a suitable alternative could expose the banking system to significant risks.
Indeed, Janine. Canada's housing market has experienced downturns in the past due to weak lending rules. The 1982 housing crash, for instance, led to the collapse of several federally insured loan and trust companies. It's crucial to balance borrower affordability with the stability of the financial system.
Absolutely, Steve. Former CMHC CEO Romy Bowers emphasized the importance of preparing for worst-case scenarios. She cited stress tests against significant national home price declines and high unemployment rates as essential measures to safeguard the economy.
Let's talk about the current state of mortgage renewals in Canada. It seems like we're not facing a full-blown crisis yet, but there are certainly some pain points. Mortgage delinquencies are on the rise, especially here in Ontario, as borrowers are dealing with higher rates at renewal than when they first secured their mortgages.
That's right, Steve. While many borrowers are managing to absorb the higher payments, some are really feeling the pressure. Thankfully, the Bank of Canada's interest rate cuts and a decrease in fixed rates due to lower bond yields have provided some relief. It seems the outlook is a bit brighter than it was when many were worried about a renewal cliff in 2025.
The Bank of Canada has indeed slashed its benchmark rate by 2 full percentage points since last year, and it's expected to cut it further. This has certainly eased some of the pressure on borrowers facing renewals. However, it's important to note that not everyone is out of the woods yet. Many are still approaching their renewals with trepidation.
Joe Samet, a mortgage broker, pointed out that while the stress test was initially controversial, it has actually helped borrowers withstand these rate increases. By stress testing at higher rates, many borrowers have already proven their ability to handle such financial pressures. Unless they've taken on a lot of additional consumer debt, they should be able to manage.
Exactly, Janine. Delinquencies, while rising, are still below historical averages. This indicates that the broader mortgage market hasn't felt a significant ripple effect yet. Most people are managing, but those who are struggling often have other complicating life events affecting their finances.
And while the situation isn't as dire as initially feared, it's not over yet. Economists have started to predict a less bumpy road for mortgage renewals in 2024, with lower interest rates and increased payments helping to front-load the payment shock. This proactive approach by Canadians to refinance and reduce spending has played a crucial role.
Yet, as Robert Hogue from RBC highlighted, despite the relief from lower rates, many homeowners will still face significant financial strain. Some may even be forced to sell, which could add to inventory and affect price growth. But thanks to Canada's stringent stress test rules, we should avoid a surge in distressed sales, maintaining balance in the market.
It's a testament to the resilience of Canadian homeowners and the effectiveness of regulatory measures, Steve. While its clear challenges remain, the steps taken have certainly helped in navigating these turbulent times. Let's keep an eye on how these dynamics continue to unfold.
Let's shift our focus to the real estate market in King, Ontario, where we've seen a remarkable surge in home prices. The average price for a home in King reached $2.74 million in February 2025. That's a staggering 47.2% increase from just the previous month.
That's quite an eye-opener, Steve. It seems like the market in King is really heating up. This kind of increase can have significant implications for both buyers and sellers in the area. For those looking to buy, it could mean stretching their budgets even further.
Exactly, Janine. The numbers are indeed impressive. Compared to February 2024, home prices have jumped 50.2%, translating to an increase of $916,451. These figures suggest a robust demand in the area, despite a decrease in sales by 18.2%.
And it's interesting to see that while sales have decreased, active listings have actually gone up by 56.2% compared to a year ago. This could indicate that while there's strong interest, the price surge might be causing potential buyers to hesitate.
That's a great point, Janine. When we break down the types of homes, detached houses in King averaged $3.36 million, marking a 55.7% increase from the previous month and a whopping 72% rise from last year. This highlights the substantial appreciation in property values.
It's truly remarkable, Steve. The market for semi-detached and attached houses is also seeing significant growth, although the volume of sales remains low. Semi-detached homes averaged $1.3 million with just one sale last month, and attached houses averaged $1.25 million, also with just one sale.
And let's not forget about apartment-style condos. They averaged $859,000, up 70.4% month over month. It's clear that every segment of the market in King is experiencing these price hikes.
Yes, Steve, and it's worth noting that compared to February 2015, the average sale price for all houses and condos in King has increased by 186.8%. This long-term growth reflects the enduring appeal and investment potential of the area.
Absolutely, Janine. While these numbers might be encouraging for current homeowners in King, they also present challenges for those looking to enter the market. The significant appreciation in property values might be pushing the dream of homeownership further out of reach for some.
It's a complex situation, Steve. On one hand, homeowners are seeing their investments grow, but on the other hand, potential new buyers might find themselves priced out. It's a delicate balance that needs careful consideration by both policymakers and stakeholders in the real estate market.
Our final topic for today is the recent developments surrounding the Canadian dollar. It seems like the loonie has weakened against its United States counterpart, falling 0.3%. This drop comes as investors anticipate further interest rate cuts by the Bank of Canada to support the economy, which is currently threatened by trade tensions with the United States.
That's right, Steve. The Canadian dollar touched its weakest intraday level since last Wednesday, hitting 1.4440 against the US dollar. It's a challenging time for the Canadian economy, particularly with the uncertainty surrounding US trade tariffs. This has made the loonie more vulnerable.
The Bank of Canada has already lowered its benchmark interest rate by 2 percentage points since June, bringing it to 3%. Investors are now seeing an 87% chance that the central bank will cut the rate by an additional 25 basis points this week. This expected rate cut is likely keeping a lid on the Canadian dollar.
And it's not just the interest rates here, Steve. The price of oil, which is one of Canada's major exports, has also fallen by 1.1%, trading at $66.28 a barrel. This decline in oil prices, coupled with tariff uncertainty, has weighed heavily on the loonie.
That's a good point, Janine. The bond market is also reacting to these developments. Canadian government bond yields have moved lower across the curve, mirroring moves in U.S. Treasuries. The 10-year bond yield has dropped by 5 basis points to 2.983% as concerns about a potential U.S. recession grow.
It's clear that the economic confidence in Canada is being affected by these ongoing trade tensions. Aaron Hurd, a senior portfolio manager at State Street Global Advisors, mentioned that economic confidence will continue to suffer as long as these tariffs loom over the market. This uncertainty is causing businesses to hold off on capital expenditures until there's more clarity.
Indeed, Janine. While the situation is complex, it's crucial for investors and businesses to stay informed and prepared for potential changes in the economic landscape. As we continue to monitor these developments, we'll keep our listeners updated with the latest insights and analysis. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.